recession that begins officially at the end of 2007. This was the worst recession in the United States since the Great Depression. And the effects of this recession are still very much being felt today in a couple of regards. First of all, the recovery from the 2007 recession was much slower. I'm going to show you some graphs here in a minute to support that point. Were much slower than in any other recession of recent history. So the effects of this recession are still being felt today. The other thing that we saw after 2007 is that the world of policy making changed. That we have kind of a different regimen, a different set of rules which controls economic policies post-07. All right? All right, so in this, like I said, this is a good way to think about business cycles and recessions. Okay, so first part, how bad was it? Well, here's one graph. This is just real gross domestic product from 2000 to 2016. All right. What you see is that through the first half, or almost 2/3 of the 2000s, the economy performed really, really, really well. This recession that we had in 2001, basically in the aftermath of 9/11, it officially counts as a recession, but it was surprisingly mild. It was just basically a bump in the road, a slowdown in growth rates. And then after a pretty quick recovery from the 2001 recession, the economy did really, really well until the end of 2007 when it nosedived. And you can see the nosedive was really dramatic. Real GDP fell from about 15 trillion down to about 13.5. So it was quite the big deal. All right. Just some other graphs which make the point. Here I'm imposing on the GDP line the red line, which indicates potential GDP. And the way we get that, and what that is intended to represent, is if you just extrapolate the growth rates that we saw between 2000 and 2007. So if the economy had performed as well as it had performed in the early 2000s, okay, that red line represents what we would have expected to see. So if you think about the recession as a missed opportunity, that gap between the red line and the blue line gives you a sense of just how much we lost from what we potentially could have had. Okay, we saw this in the unemployment numbers. Here I'm projecting these just to 2013 because I want to focus on what happened during the recession. As we talked about last week, the unemployment rate is now back down to a little bit below 5%. But during the recession, we saw unemployment spiking almost to 10%. Okay. So this decline in GDP was matched by almost a crisis in employment. Okay. Here's I pulled this from chapter 10 of the text because I think it just gives you an interesting juxtaposition of what happened during the 2007 recession and compares that with what typically happens during a recession. And again, the story here is things were really bad. Recessions are always bad, but typically we see a drop in GDP. The average drop in GDP during a recession is about 1.7%. During our recession, we saw almost 3 times that. Non-farm employment typically falls by 2.5%. Here it fell by more than twice the usual amount. The unemployment rate usually goes up by 2.5%. It went up by 4.5% in this recession. And when you look through these two numbers, the components of GDP, you see something every bit as stark. What happened? Well, consumer spending fell from 0.4, the growth rate fell from 0.4% to a negative 3.4%. or compared rather to the what happens in a typical recession. This second line here, investments, I think is remarkably striking. All right, typically, and this is private investment, falls by about 14% during a recession. During 2007, investment fell by, what, 34%. Okay. Remember, investment is it's what gives you productivity growth in the future. So, again, when you think about what we lost, the potential that was wiped out, it's pretty dramatic. Notice also the third line, government purchases. Now, we typically see during a recession government spending increase as a way to stimulate the economy, right? Go out and buy some new roads or boots for the army or whatever it might be. Usually government spending goes up by, the average during a recession is for government spending to go up by 1.2%. During the 2007 recession, stimulus spending on the part of the government went up by 5.5%. So the government made a big push, and sometimes you'll read people who just don't believe the numbers. The government made a big push to increase spending during this time, and what you saw from the previous graph is you can see where it comes.
Is there a direct correlation between investment and the velocity?
Probably you could make the argument. Yeah. Yeah. There's probably some links there if you wanted to explore them, but I don't think that's the primary story. This isn't a monetary story. It's a story about the real economy. So, good.
How does this compare to the Great Depression?
Yes, it's the second worst. Now,
well, the spending by the government purchases.
I'd have to look those numbers up, but the averages that I'm giving you here do not include the Great Depression.
Wasn't that a huge part of us getting out of the Great Depression, was the government spending so much for World War II?
Yeah, that's the argument that you hear made, although that's a bigger story of the fact whether that was really the contributing factor. And we're not going to have that argument today because I win. At any rate, here's kind of what I'm showing you about comparing. And again, the takeaway from this is that this event that we experienced in 2007 was just different order of magnitude from what we'd seen before. Okay, just in case you still don't get it, here's sort of the employment losses during the post-World War recessions. It's another one of these graphs that I like that I stole from your book. And the real message again is compare our recession with any other recession since the war, and you see that our recession was worse. Okay, so I think I made my point. It was really bad. Okay, and now the question is, why was it really bad? What was different about 2007, which caused us to enter into this recession, and why was it so uniquely unstable? Okay, well, here's conventional wisdom, although I'm going to end this little diatribe this morning with a couple of other factors that may have also contributed to the 2007 recession. Conventional wisdom is to do with housing prices. So I know most of you were paying attention at least a little bit back then, but just in case you were, this coincides with when you were in your hippie phase or something like that, weren't paying attention to the news. Here's the Case-Shiller 20 City Composite Home Price Index. By the way, the Case-Shiller, which I guess is now owned by Thomson Reuters, I think. The Case-Shiller Index is sort of the go-to source for housing prices house price indices. Some of it's private, you have to pay for it, but a lot of the Case-Shiller data you can just get for free. So here's the Case-Shiller 20 Index, good composite price housing prices, and what you see is a story that, again, probably most of you remember. The early 2000s were a big run-up in housing prices, right? Everybody wanted to get into a house before the prices went up by even more, and then pretty catastrophically, beginning actually in 2006, the bubble burst and housing prices fell. Okay? So when you ask why did we enter a recession in 2008, this graph is the conventional answer to that. Okay? That people had experienced substantial increases in their wealth during the Depression when their house prices went up. House prices fell, and that made people poorer. It really substantially affected a lot of people who lost their houses. And as a consequence, spending fell and we entered into this recession. Okay?
Well, wouldn't it have made, if the housing prices fell, like if they had debt on those houses, the banks were like, okay, well, you have to, pay for the amount over,
Not necessarily. Let me pick up on why this story is, I'm not going to say it's wrong, but it's a vast oversimplification of what happened. So again, the story of why we had a recession, housing prices had gone up in the first part of the 2000s, then housing prices fell, and that bummed everybody out, right? People lost their houses and they felt poor, they didn't buy cars and take vacations. All right, so, just the numbers which correspond to my graph here. Between 96 and 2006, housing prices, went up by a substantial amount. They almost doubled. And then between 06 and 2012, housing prices fell by 42%. All right. And let me skip ahead. I want to come back to this question. So I'm going to challenge that notion that the recession is explained primarily by the burst of the housing bubble and that affecting individuals. So you guys know all about the housing bubble. What you may or may not be too young to remember, hope that wasn't condescending, is that we have seen bubbles burst in this economy before. Most recently, before the housing price bubble burst, was the so-called dot-com bubble. So during the 1990s, tech stocks were just the newest and coolest thing, and everybody had to have some. So we saw this tremendous appreciation in pretty much the value of any stock with, internet tied to it, right? You guys, does anybody remember PetSmart.com? Right? Online, you're going to be able to get pet food delivered to your door. Somehow, the market thought this would be more valuable than AT&T. Right? That's silly, right? And so, in let's call it 2001, we saw the kind of rationality return to the asset value of a lot of tech companies. Okay, that represented, when the dot-com bubble burst, a lot of people lost money. Okay, that represented a decline of wealth of about, the scale here is, now I have to remember, it's trillions of dollars, I think, yeah, trillions of dollars. Okay, about $7 trillion worth of wealth was wiped out in a fairly short period of time when stock prices in the tech world fell. Compare that with the amount of wealth that was wiped out during the housing bubble burst. Okay? A lot more people lost a lot more money during the dot-com bust than lost money during the housing bust. Okay? Yet compare the two recessions. The 2001 recession was mild and short. Okay? The 2007 recession was horrific and long. The point here is that if you say it was just the loss of wealth that led to the recession, well, you have to tell me, why is it that we didn't have a much bigger recession in 2001 when a lot more wealth was wiped out in the aftermath of the bubble bursting? Okay? Here, I think, is the answer, at least part of the answer to that. Let me flip back up. Oh, come on.
we get liquidity going into that?
Yeah, and that's kind of where I'm going with this. So what I want to do now is ask, why did we see that graph? Why did housing prices go up and then fall? And then what was special about the aftermath of this? So why was there a bubble? All right? Part of the answer has to do with interest rates. Here's a graph. And this is a graph that goes back a long time, goes back to 1970, of the 30-year conventional mortgage interest rate. And what you notice when you look at this graph is that beginning, let's call it in the mid-1980s, after the 81-82 recession, mortgage rates began to fall, and mortgage rates fell over a period of almost 25 years. Okay. So it was becoming, in the 2000s, cheaper and cheaper and cheaper to borrow money to buy a house. So maybe the reason we saw that rise of housing prices was just in response to low mortgage rates. Okay? Now, that's true. And if you look at my graph a little bit, and it's kind of hard to see, but I'll highlight it for you. Beginning in the mid-2000s, 2005, 2006, rates began to creep back up. So maybe the story is declining rates led to a frenzy of buying of houses. When rates began to go back up, the frenzy stopped. Okay? So that could be part of the story. Another part of the story, and you read a lot about this, bad underwriting. Okay? That about 20% of the home loans that were made in 2006 were so-called subprime. Subprime means that the borrowers did not achieve conventional underwriting standards. And that could be for a lot of reasons. They may have had a low credit score. They may not have had reliable indication of work. They may not have a steady work history. But for whatever reasons, these were people who would not have normally qualified for a home loan. They got a home loan. They were in the so-called subprime market. Yep.
Wasn't there some policy from the government that
Sure.
kind of relaxed these standards too?
Yeah, and then I think, did I have a bullet point on this? And by the way, I'm hoping everybody saw the movie. The movie was entertaining. The book is even better if you haven't read the book, The Big Short, where we kind of talk about, there's some great stories in the book about some, shall we say, exotic dancer in Las Vegas who owned like 5 houses with God knows how much in mortgage standard. Anyhow, okay, and I guess I didn't put the bullet point, but just to pick up your point, there was also, there were a couple of things, most importantly, something called the Community Reinvestment Act, I think that's the acronym, which was designed to it was designed to encourage banks and mortgage lenders to provide loans to lower income households to get them, make them homeowners. And that was, by the way, a bipartisan, the Bush administration supported it, the Clintons supported it.
You get a tax reduction going on?
They got some other benefits, regulatory relief in other ways. Okay, so so there's this bad underwriting story that goes along. Now, one point to make here is that if we had a home market in the early 2000s where prices were rising, credit underwriting really didn't make much of a difference. So think about what happens if you loan money to a deadbeat to buy a house. They don't pay you back, you foreclose the house. That's kind of expensive if you're the mortgage lender, because you've got to actually go through the process. You probably have to do some maintenance and clean up on the house. But if housing prices are going up, you foreclose on a house, you expect to be able to sell it if you're the institution that foreclosed, you expect it to be able to sell that house and get your money back. Okay? So while we probably can say pretty clearly, no one would disagree with this, that underwriting standards were loosened in the 2000s. It kind of makes sense to think they would have been loosened because underwriting just didn't matter as much back then. Okay, I showed you that. So those things may have led to the decline in housing prices. And again, to review, the housing bubble may have been caused by a combination of low interest rates and bad underwriting. But why did the burst of the housing bubble cause such a big recession? Okay, so again, it gets back to this picture. Why was the events of 2000s so much more devastating than the dot-com burst? Okay, so one explanation is that housing may be different. People, when they lose money on the stock market, may react differently to that loss than when they lose money in the housing market. So who's buying dot-com stocks? Well, it's probably wealthy individuals and investment funds. They're in a position, they lose $8 trillion, they say, okay, we'll get it back tomorrow. And they just get on. Who loses money when housing prices fall? Well, probably a lot more kind of middle class, non-professional investors. And they may react very differently to the loss that they observe in their house. Okay? So that could be part of what's going on. Houses are just special. Okay? But I think a better explanation, or certainly a more complete explanation for why 2007 was so uniquely bad, was because the collapse in housing prices led to a bigger problem, and that's a collapse in the financial sector. Okay? In fact, finance, not housing, was probably the real cause of the 2007 recession. So, let me remind you of a couple of things. One is what we mean by securitization and why it happened and why it's actually in many ways a good thing. So the process of securitization describes the process of taking a lot of individual mortgages, bundling them into packages, bonds usually, or some sort of a mortgage-backed security as it's called, and then selling off not a single mortgage, but a bundle of mortgages. That's what we mean by securitization. So you take 1,000 mortgages, you create a bond, and then you sell that bond. You sell pieces of the bond. Okay? Now, that's actually a really good idea. It's a good idea because it effectively creates, or at least in principle it's a good idea, because it would create a diversified bundle of financial assets. Right? So if you have a fund which has, say, 10,000 mortgages in it, in principle, if 1 or 2 mortgages go under, or if 100 or 200 mortgages go under that they don't get paid, you still have the other 9,800 mortgages which are being serviced properly. Diversification works. The problem is securitization works. The problem is that for securitization to work, the underlying risks have to be uncorrelated. So if mortgage-backed securities were going to do what the financial engineers who designed them promised that they would do, the underlying risks, the underlying assets had to be uncorrelated with each other. If a mortgage-backed security contains mortgages that are all more or less the same, then it's very likely that if one subset of this bundle of mortgages fails, a whole bunch of them are going to fail. It turns out that's what happened during the financial crisis. An awful lot of financial institutions that had reputations for being sophisticated, managers of risk just failed in their job. A lot of these so-called mortgage-backed securities were not really bundles of diversified, uncorrelated mortgages. What that meant is that when one failed, another would fail, and the whole bundle would unravel. Now, same observation that I made a minute ago. In a world where housing prices are going up, none of these things matter. In a world where housing prices are going up, it doesn't matter whether 2% of your borrowers default or 15% of your borrowers default, because you can foreclose on the house and recover your loan. So it's easy to say there was bad risk management on the part of the big financial institutions in the early 2000s. But maybe that's unfair, because it didn't look like risk management was all that important. Okay? In any case, it proved to be very important. As these mortgage-backed securities began to fail, the system began to unravel. Okay? Now, there was one other problem that was probably every bit as severe as the collapse of the financial sector when these securities that had been basically poorly designed began to fail. The other problem that we observed was essentially a liquidity problem. When institutions began to fail, in particular Lehman goes under, people just lost confidence in the financial sector as a whole. A number of relatively well-run institutions then experienced extreme liquidity events, which just is a fancy way of saying there was a run on the bank. Okay. This lack of confidence in the system, as well as the collapse of the mortgage-backed securities, may help really understand why we had the horrible recession that we had. Okay, now a couple other points on this before I lose my end the discussion of the Great Recession. There were a couple of other issues. Jonathan, go ahead before I dig into this.
What about greed, Professor, on the part of consumers as well as the bankers? People just tried to buy houses they couldn't afford, and the bankers didn't care because they were going to
be bailed out. Yeah, there's that greed.
I would argue, is the real answer.
Yeah, I could do my Gordon Gekko imitation and say greed is good. For those of you who don't know the reference.
I agree, but I mean.
But here's the I think the more sensible. I have a friend who says, I wish I had thought about this, but I have a friend who says blaming the recession on greed is like blaming a fire on oxygen. Greed is always with us. You know, people have been greedy since the beginning of time. So there had to be something else to precipitate the events. Okay, and that's really what we're talking about. Now, let me just throw out two other things that I think sometimes get lost in the history lesson. So there's a tendency to blame all of the 2007 recession on finance and houses, but there were two other things going on. One is energy prices. Okay, so this is the story of West Texas Intermediate, but I could have picked any energy price index to show you. So in the early part of the decade, we saw this really rapid increase in energy prices. Oil prices reached almost $140 a barrel. Okay. That caused problems in the real part of the economy. As energy prices went up, people were squeezed and businesses were squeezed on other dimensions. Think about the airline industry as an example. There were a wave of bankruptcies that occurred during this time period because gas prices are a big component of airline costs. You also saw the collapse in energy prices during the recession, which had big impacts on certain sectors of the economy, namely the energy producing sectors. So this crazy pattern of energy prices that we saw in the early 2000s and then during the recession, that instability may have had a big impact on the recession as well. There's one other thing, and that helps us transition into the next topic for today, is what's sometimes referred to as the international savings glut. In just a few minutes here, I'm going to start defining these things more carefully. The capital account, though, measures the flow of money coming from outside the U.S. and being invested into the U.S. Okay? As it turns out, there was a lot of savings going on outside the U.S., especially in China. Okay? That savings had to be invested somewhere. And that savings tended to flow mostly into the United States. So during the periods before the recession, the U.S. saw a big influx of capital from outside the U.S. Then there's a spike, and then it flatlines. Okay. This is something that's hard to assess just how important it is, but it's certainly plausible to think that this kind of crazy movement of money out of China into the U.S. during the 2000s was a big part of the problem. Okay? Kitty.
Going back to the housing prices, what caused them to drop? And I apologize if I missed it.
The best guess is it was when the interest rates started to increase, so that increased the burden on people who had borrowed money. So the story that people tell, an example of what had been going on. You had the exotic dancer in Las Vegas, right? And she's definitely, personally, she's probably a fine human being, but she's subprime in terms of her credit. Okay, but she gets a loan.
Yeah.
And now they're not going to give her a 30-year conventional fixed rate mortgage. Right. She's going to have a variable rate mortgage. And if she took that loan out in 2003 or 2004, the rate she got on that mortgage was very low. All right. And then when rates began to trickle back up, and there were like 4 or 5 rate increases from 2005 to 2007, something like that. When rates began to trickle back up, her mortgage rate was reset because it's a variable rate mortgage, and all of a sudden the payment that was relatively easy to make becomes very, very hard to make.
And that affects the value of the house, though?
It does if she, so at some point, you've got these subprime borrowers, they're squeezed by higher interest rates, and they default. And then all of a sudden you've got a house that is foreclosed and goes back on the market. So you could go into certain real estate markets, and I didn't pick Las Vegas just because I like to talk about exotic dancers. Las Vegas was the classic example of this. You could go into neighborhoods in Las Vegas in like 2009, 2008, and you would just see block after block of new houses which would have for sale signs, and they'd all be being sold as part of either a foreclosure, basically, or a short sale.
So it was also a factor that they were at sort of the peak of housing prices at that time as well, so that was the reason?
Yeah, and the question, though, is why did they peak when they peaked, and then why did they begin to fall? And the best answer seems to be because interest rates began to creep back up. And that combined with the bad underwriting put pressure on borrowers.
So is inflation a factor in that too?
No.
The houses were priced higher than they were worth?
Yeah, there was certainly inflation in housing prices. The other interesting thing, let me go back to this graph. So one thing which we don't understand, and there's kind of this don't understand is a good takeaway for this little part of the lecture here. So you'll see we had big run-ups in energy prices, and we had big run-ups in home prices, and I'm talking about more this period, this 2004. We didn't have a lot of overall inflation. So you saw these two asset classes, energy and houses, going up in value, but you weren't seeing prices going up all across the economy, and that's kind of weird. So anyhow, okay. So there's your story there. Okay. Oh, I'm sorry. One more thing to point out. The housing crisis and the recession of 2007 was not exclusively a U.S. problem. We saw much the same thing happening in several other parts of the world. So if you were to look at Ireland, their story is very much like our story. Iceland, for God's sake, had huge boom and then a bust. So at the same time we were having our recession, you saw growth slowing down all over the world. Okay. All right. So takeaways from all of this. We'll do everything else. There's the other stuff up. I guess kind of the biggest takeaway that I would offer you guys, and it's really almost the same thing that I said last week when I was talking about the election stuff. You have to be aware of expert opinion and understand that what happened in 2007 was really a surprise. We believed, and I've definitely put me in this category of we, going into the recession 15 or 12 years ago, let's say, that the financial sector was relatively stable and solid. There was not, I think, a real understanding of the underlying fragility in the financial sector. There was an understanding of just how much of this debt was being circulated, how many of these mortgage-backed securities and derivatives based on these mortgage-backed securities were important. So again, it's kind of, the message is humility. All right. So, let me make sure that this is my next set of notes. What I'm going to do now for something kind of completely different. I'm going to talk about the international monetary system. And there's going to be a lot of moving parts here. So, I'm going to give you a heads up on how things are going to be organized both this week and next week. I'm going to begin by talking about exchange rate systems, and then I'm going to kind of give you a sort of a brief history of the world, and then I want to talk about the costs and benefits of a single currency and a fixed exchange rate system. Okay? So, and I promise you I'm actually not trying to get real political here, but one of the reasons I decided to kind of maybe do a little bit more on this in this class than I would typically do in a macro class. There's going to be obviously some really big, how do you say, conversation. I would say shrill and heated argument is a better way of describing it. Over the next few months about international trade and the international monetary system. As again, if you were paying attention at all, you know that one of the things that Donald Trump was arguing about, and a lot of his supporters are arguing about, is China. There's the claim that's made that China is artificially devaluing the RMB in order to gain an advantage in export markets, that China's cheating in their currency regime. I'll tell you right now, that's just wrong. That's not what's happening. But the only way I can get you to understand what is happening is if I tell you a little bit about how exchange rate systems work. So that's what we're doing today. All right, so it's going to be a little bit of theory, a little bit of facts, and then some analysis. All right, so the theory. And this is the theory of exchange rate systems. And it gets back to a very basic question, which has a pretty obvious answer. Why does the world need some sort of mechanism for exchanging currencies? Why do we need to buy euros or RMB?
Because people travel
Okay? People travel,
Do international business?
and they do international business. Okay, so that's, I'll just block it right here. Why do we trade currencies? The first reason actually is not the one you just mentioned, but I'll get this one out of the way. Sometimes people trade currencies because they want to make money. There are currency speculators out there. They're not doing anything illegal or immoral or unethical, but they're just trying to make money on movements in currency values. So why would you want to buy currency? Well, you might want to buy currency just because you think it's going to appreciate in value. Okay? The more fundamental reasons, though, to buy currency is the one Jonathan just mentioned. You might want to trade currency in order to facilitate some underlying exchange. You buy British pounds because you're going to London next week. Or you buy British pounds because you want to import it's a Jaguar. Right, one of them. Okay? There's a third reason why you might want to buy or sell foreign currency. And that's because you want to invest in financial instruments that are denominated in another country's currency. Now, I want to separate this motivation from trading currencies because you think the currency is going to go up or down in value. The idea here is that someone might, well, imagine that, say, someone wants to buy 10 million euros worth of bonds that are issued by the city of Berlin. Okay? Well, that may or may not be a good investment, but if you're an American and you want to make that investment, you gotta get the euros in order to buy the bonds. So again, third reason here is to make an investment in some financial asset, and it's different than investing in the currency. Okay. All right. Now, so that's why people need to trade currencies. To understand systems for trading currencies, you have to begin to think along a continuum. There are two, totally opposite ways by which a currency exchange system might work. Currency exchange system can be a floating rate system or a fixed rate system. So, let me talk to you about each of those. All right. When we say that a currency exchange system is floating, what we mean is that the exchange rates are determined entirely by the forces of demand and supply. The prices of currency are determined in the same way that we determine the price of any other commodity. All right, now that actually tells you a lot about the way the world would work if there is a floating exchange rate system. So let's do a little analysis. Let's do a demand and supply story about, say, the market for euros. Okay, so kind of micro 101. I know Croson taught you all about this. Demand and supply. So we're going to put on the horizontal axis, we'll measure the quantity of euros that are purchased and sold. And on the horizontal axis, the vertical axis, we'll measure the price of euros. And just to make sure we follow the usual conventions, prices are going to be indicated as dollars per euros. As you may have noticed, there's always two ways to quote the value of a currency. I could tell you that, pick an easy number, suppose the exchange rate between the dollar and the euro is that 1 euro costs $2. So I could say the exchange rate is 2. I could also say the exchange rate euros per dollar is equal to 0.5. Okay? So just, again, just to get it out of the way, we're going to quote the exchange rate as dollars per 1 unit of the foreign currency. Okay, when you do that, then you get the usual, micro 101 story. The demand curve slopes downward, and the supply curve slopes upward. And the equilibrium price, I'll call that P0, is determined there. And the equilibrium quantity in the market is determined there. Again, you're getting warm and fuzzy feelings right now for David Croson, who I saw, by the way, last week. He's doing very well and sends you his best. But there you go. Okay, so that's just, this is what happens in a free market float where exchange rates are allowed to float. Okay? Now here's the interesting part. Let's think about the factors that might cause the exchange rate to change. And in particular, I want to highlight two kinds of things. The first thing I want to talk about is what happens to the exchange rate in a floating rate system where relative inflation rates change. Suppose I told you that the rate of inflation in Germany, or in Europe, so call that the inflation rate in the euro, is now going to be 6%. And at the same time that's true, the inflation rate in the US, suppose I told you that it was going to be 2%. Let's think about how that would alter my demand and supply picture. All right, so I need, who in here, Rich, would you like to have a Porsche? Sure you would. It goes without saying, red-blooded American man. You definitely want a Porsche, okay? And you're thinking about buying one, right? But you're also thinking about buying a Corvette. All right, yeah, Porsche, Corvette, all right, humor me. So you look out there and you say, well, I'm on the fence between these two, and all of a sudden you observe the price of the Porsche has gone up by 6%, but the price of the Corvette has only gone up by 2%. Well, to ask the question is to answer it. If he's really on the fence between these two cars, that'll probably drive him to buy the Corvette. Okay? So, think about what that means. That means that instead of demanding euros in order to buy the Corvette, he's not going to be demanding euros. In terms of my sort of Croson 101 story here, if we have this alignment of inflation rates, that just means that people want to buy fewer goods from overseas, which means that they will be demanding fewer units of the foreign currency. The demand curve will shift back like that. Let's call that D1. But wait, there's more. Because Rich is thinking about Corvette versus Porsche, there's somebody in Germany and they're thinking about their vacation. Right? They're thinking, okay, when we go on holiday, we can take the kids to Greece, or we can take the kids to go see Disney World. Which is why you would do that. I don't know. But that's, the Germans love Disneyland for some reason. They're a strange people. Okay, so you're this German guy and you're planning your vacation. All right? And you look out there and you say the same thing, right? Prices in Greece have gone up by 6%. Prices in Orlando have gone up by 2%. I'm on the fence, I'll go to Orlando. What does that mean? Well, if you're going to go hang out in Disneyland, you need dollars. Lots of dollars. Okay? How does the German get the dollars? Well, they demand dollars, but what they're really doing when they demand dollars is that they're supplying euros. So, again, it's David Croson 101. We would expect to see a shift back in the supply curve. like that. Okay, what does that mean about inflation, or excuse me, about exchange rates? What happens to the equilibrium price of currency when this set of changes kicks off?
It doesn't look like it changes.
Oh.
Year graph.
Price increases?
Okay, yeah, you have, I'm sorry, and I drew my graph in, why did I say a decrease in supply? What's the German doing? He's increasing the supply of euros. So, he's got to supply euros in order to get the dollars he needs to pay for the vacation. All right, so now I'll ask my question again. The supply curve has shifted to the right as a consequence of the increase in supply. And now you can see it hopefully pretty clearly. What's happened to the equilibrium exchange rate? It's gone down. Okay? So, what I'm pointing out to you is that in a world where exchange rates can float, relative inflation rates are going to be really an important determinant of what the exchange rates are. If the inflation rate in the foreign country is greater than the inflation rate in the US, that's going to drive exchange rates down. And of course, if I had turned the story on its head, if I'd said that inflation rates in the US were going to be bigger than inflation rates in Europe, then, you know, my graphs would have just gone the other way, and we would have seen that exchange rates would have gone up. So under a floating rate system, what matters? Well, one thing that matters is inflation rates. And to be really correct, I should say relative inflation rates. Okay? Let me show you another thing that really matters. And it hooks back on the point that I was making earlier too, which is that people buy currency both to buy goods and services. They buy currency to buy Corvettes and vacations at Disneyland, but people also buy currency in order to make investments in other countries. Okay? So let's imagine, again, we'll start with a demand curve that slopes down and a supply curve that slopes up. And now let's imagine that interest rates in Europe, so I'm going to show you that what matters is relative interest rates. The interest rates in Europe relative to the United States, let's suppose that they go up. And I'll just indicate that this way. So the relative European interest rate compared to the US interest rate, let's suppose that that goes up. So maybe their rate on a 10-year bond was 3%, and our rate on a 10-year bond was 1.5%. And now suppose they raise their 10-year bond rate from 3% to 6%. Then that ratio of interest rates goes up. Okay? Now, let's again trace through the impacts on the market for foreign exchange. And let me stipulate, by the way, that these are interest rates which are adjusted for risk and adjusted for inflation. So the real risk-adjusted rate of return in Europe has gone up. Now, what are American investors going to do?
They're going to put their money over, they're going to exchange their money, their dollars.
And invest. Maybe not all of it, but they're certainly going to increase their investments in Europe. Bond yields in Europe, real risk-adjusted bond yields have gone up. You shift at least some of your portfolio out of U.S. instruments and into euro-denominated instruments.
So that would increase the demand.
And that's exactly right. That causes there to be an increase in the demand for euros. Of course, what about the Europeans? They're seeing exactly the same interest rates. What are they going to do with their investments? Are they going to increase or decrease their investments in Europe? They're going to do the same thing. They're not fools. They'll look at that change in relative yields and invest more in Europe. As a consequence of them investing more in Europe, they're going to be supplying fewer euros into the market for foreign exchange. They don't need to buy so many dollars because they have no need to buy US denominated bonds or dollar denominated bonds. So what's going to happen is that the supply curve is going to get shifted back like that. And again, hopefully you can see the story. What impact does that change in interest rates have on exchange rates? Up or down?
Exchange rates are going up.
The exchange rate is going up. It'll go from here, call that P0, up to here, call that P1. Okay, so kind of the takeaway from this, well, there's sort of three things I want you to understand. First, just understand what I mean by a floating exchange rate. A floating exchange rate is just an exchange rate that's determined by the forces of demand and supply. That's it. The second thing to understand is that in a market where exchange rates are allowed to float, inflation is going to matter along with relative interest rates. Inflation rates and interest rates matter. Okay? Now, that circles back on something we talked about both last week and today, and that's the importance of the central bank. The central bank controls inflation rates through their control of monetary base, and the central bank also exerts a powerful control over interest rates.
Isn't that through the Fed funds rate?
Yeah, through the Fed funds rate and through other mechanisms as well. Okay? So, kind of a takeaway here is that under a floating rate exchange system, the Federal Reserve, the central bank in any country really, is particularly important. Okay? All right, now, I think I've just got enough time to do this. Floating exchange rates are one system. Fixed exchange rates are another system. An alternative exchange rate mechanism. And by a fixed exchange rate system, I just mean a system in which the government or the government acting through their central bank fixes the exchange rate. This fixes the exchange rate. All right? Now, to understand how that would happen, okay, I need to do an experiment, or a fake experiment. Suppose I decided, as the Lord of this classroom, that I'm going to fix the price of bottled water. The only price that I will allow to have happen in this classroom is $1 per bottle. All right? How could I do that? Well, one way I could do that is to threaten to beat up anybody who bought or sold water at a price different than $1. All right? How would that work out for me? All right? For instance, I've forgotten your name.
Josh.
Josh, stand up just for a minute. Okay? Suppose I catch you selling water for $1.50, and I say, you son of a, I'm going to take you out. How is that going to work out for me?
Probably not well.
No, thank you. Yeah, I think, if you and I had a fight in an alley, probably 2 out of the 3 times you'd take it. All right? Just saying. Okay, so here's the problem. If I just say, damn it, nobody can sell water for a price other than $1, that's not going to work. Okay? Just a real quick story. If you went to the Soviet Union in 1977, the exchange rate between the dollar and the ruble was fixed. Okay? Nobody paid a bit of attention. I don't know if anybody's been to Argentina in the past year or year and a half.
You go to Argentina, where you went a year ago, which is the last time I went, the exchange rate between the peso and the dollar is fixed by the government. But nobody cares, right? You just walk down the street in Buenos Aires and you can buy and sell dollars at a rate much different than what the government says. You know, they can't beat up everybody and they don't even try, right? But how could I fix the price of a bottle of water?
If you control all the water?
Yeah, I don't even have to control all the water. Here's what I have to do. I'll just tell you this, so we're almost out of time today, so let me just give this one away. If I really wanted to fix the price of water, what I would do is I would have two tables. And at this table, I would put up a sign and it will say, I will buy water $1 per bottle.